Good morning, everyone. Welcome to today's market commentary. It's Wednesday, March 19th, and we have a full lineup of global market updates and investment insights to cover. Tariff uncertainty remains front and center. The key theme driving markets today is the lingering uncertainty surrounding global tariffs. US equity markets jumped again overnight, largely fueled by speculation around trade developments. Yesterday also marked the GTC keynote from NVIDIA, and the company's outlook was in line with what CEO Jensen Huang had previously telegraphed. This year's shipments will center on the GB200 chip, while GB300 is slated for rollout next year. The market had largely priced in this expectation. However, attention quickly shifted back to trade policy. There had been hope that Huang's presentation might help lift overall market confidence, but the spotlight was stolen by news surrounding so-called equal tariffs. An announcement was made yesterday suggesting some progress on this front, but details remain murky. Chairman Tsai later confirmed that equal tariffs would move forward as planned, but markets were rattled by confusion around how each country would determine its own tariff rates. This triggered a jump in the Capital Futures IVO index and helped fuel a broader rebound in US equities. Investors also kept a close eye on geopolitical developments. 1. Russia-Ukraine ceasefire talks. Former President Trump and Russian President Vladimir Putin reportedly reached a temporary agreement to halt military activity in Ukraine for 30 days. This move is being interpreted as a tactical pause, though its long-term significance remains uncertain. 2. Renewed Middle East tensions. In contrast, the Israeli military resumed operations against Gaza and Hamas after a brief ceasefire. This has reintroduced instability in the region, sending oil prices higher and boosting demand for gold as a safe haven asset. On the macro front, global growth expectations are softening. The OECD has hinted at a mild downgrade to global growth forecasts, especially for the US. Last week, I mentioned that Trump's recent talks with Bissett affirmed the short-term rally in US equities, but the underlying tariff pressures continue to cloud the outlook. Chairman Tsai emphasized that the White House is politically inclined to curb large-scale government spending going forward. Under the Biden administration, significant fiscal stimulus has already been deployed, and the sentiment is shifting toward monetary restraint. Bissett noted there's no guarantee the economy will avoid a downturn. In fact, uncertainty itself is fueling volatility. This explains why the sharp sell-off we saw yesterday wasn't entirely unexpected. Bissett also confirmed that each country will receive its assigned tariff rate by April 2nd. Originally, the rollout was supposed to occur in 3 phases, but that plan has now been scrapped. Each country, including Taiwan, mainland China, and Canada, will receive its specific rate by that date. While most are expected to hover around the 15% mark, some could be higher or lower. The issue? Many countries are still in the assessment phase, and it's unclear whether everyone will hit that deadline. This lack of clarity is fueling market doubts. The more opaque the process, the greater the volatility. There's also talk that some countries may try to negotiate exemptions with the US after the numbers are released, a move that could further complicate global trade relations. Meanwhile, the number of overlapping trade disputes is expected to rise, with tariff hikes and countermeasures now in play. As we said last week, the tariff story is far from over. With major institutional flows still on the sidelines, we're seeing only shallow rebounds in both US and Taiwan equities. Most rallies have been capped around the 10-day moving average. Recent US data indicates that corporate buybacks may pick up in April, offering some support. Additionally, US fund managers have significantly raised their cash holdings, reflecting a broader de-risking stance. Tech stocks are being trimmed, and capital is rotating toward value plays, especially in Europe and Hong Kong. This cautious stance is also supported by macro uncertainty. A month or two ago, many assumed tariffs were just a bargaining chip. Now it's becoming clear they're real policy. That realization is pushing investors to increase cash buffers and rotate into defensive sectors with strong pricing power. Oil prices surged again on Middle East headlines, but we view this as a short-term rally. Medium term, the trend remains weak due to slowing global demand, increased US output. Limited stimulus traction in China gold, on the other hand, is gaining traction as trade tensions and geopolitical risks rise. The metal is trading along its 5-day average and could extend gains if uncertainty persists. Copper is showing relative weakness. Though recent Chinese stimulus measures may lend some support, we view any pullbacks as potential entry points. US economy, cooling but not collapsing. Recent economic data suggests the US economy is cooling. Employment and retail sales are moderating. Real-time inflation, trueflation, has dropped to around 0.65%. GDP now estimates have improved slightly from 2.8% to 1.8% over 2 weeks. This deceleration isn't dramatic, but it does signal softness. Markets are now pricing in fewer rate cuts from the Fed, shifting expectations from 3 to 2, likely in June and September. While equity indices have rebounded, underlying earnings expectations tell a more cautious story. The current S&P 500 forward PE sits at 20.76, well above the 5 and 10-year averages. If economic growth slows further, EPS revisions may pull valuations down toward China 18 3x. Right now, sentiment remains fragile. We're either seeing extreme fear or short covering rallies. Investors should be cautious until there's more clarity from the upcoming Lanzhou FOMC meeting. If the Fed strikes a dovish tone, markets may stabilize, but if hawkish language returns, we could break below the 5-day average and enter a new leg lower. Yesterday, we saw capital flow back into risk-off sectors like energy and healthcare, while tech and discretionary names remained under pressure. The so-called Magnificent Seven stocks underperformed following the GTC event, and Meta was hit hard after cutting its full-year forecast. Tesla also came under pressure after RBC lowered its rating, citing increasing competition from Chinese EV players. Intel saw a modest bounce following insider buying news, but the broader trend remains weak. Tesla continues to face downward pressure as EV competition intensifies, especially from BYD and other Chinese manufacturers. Tesla's CEO remains unbothered by policy risks, which is raising concern among analysts. Institutional positioning. Defensive shift continues. Recent data shows that institutional money has moved away from high beta names and is rotating into safer assets. PokerShot, for example, remains near all-time highs, with increasing allocations to Japanese equities. Berkshire Hathaway has added further to its positions in 5 major trading houses in Japan, boosting investor confidence across the region. In the US, fund managers continue to raise their cash positions. Transactions are down, and there's a visible de-risking as tech stocks get trimmed. The market is favoring low-volatility European and Hong Kong stocks, which outperformed yesterday. Taiwan's equity market remains resilient despite 16 straight sessions of foreign net selling. Large-cap tech stocks, particularly in the AI space, face pressure due to monthly futures settlement. We're seeing capital rotate toward high-dividend, value-oriented sectors with stronger foreign exchange inflows. Names in auto components, especially those benefiting from aftermarket trends, are showing strong momentum. East Asia Corp surged another 3.5% to a new all-time high. As tariffs push up the cost of new cars, used cars and the aftermarket service sector are expected to benefit. Lenfake and Jiangsu posted strong gains, driven by new partnerships, including one with Google. Defense-related stocks are seeing increased interest after Germany's 8,100 spending plan on national defense. Japan's defense sector has already seen strong momentum, and Taiwan may follow suit. Steel and plastics are maintaining strong trends, good for range trading strategies. Electronic component stocks like Meili look attractive due to strong fundamentals and favorable valuation. Networking stocks may benefit from a potential US ban on TV-Link, potentially redirecting orders to Taiwan suppliers. Industrial computers and memory stocks continue to perform. NAND flash prices are rising, boosting profit outlooks for players like Weigang. IC designers, such as Liangqiang, show constructive chart patterns and strong buying interest. In Japan, the weakening yen continues to support export-driven stocks. Despite a minor pullback last week, we see continued upside as US. Japan rate differentials widen. European equities remain supported by incoming fiscal stimulus and improving GDP expectations. The euro has strengthened modestly, supporting our overweight view on European assets. We're entering a phase of heightened policy risk, where every headline on tariffs, rate cuts, and geopolitical conflicts can swing the market. Stay nimble, stay defensive. And until we get more clarity on April 2nd tariff numbers and the Fed's trajectory, keep a close eye on liquidity and earnings revisions. That's it for today. Thanks for tuning in to Capital Futures Market Insights. Until next time, stay sharp and stay invested.